Arbor Realty Trust is currently sitting at $5, hovering near its pandemic lows. The market is pricing the equity as if the company is marching toward imminent insolvency. This chart shows a massive divergence. On one axis, the stock price collapses. On the other, we see the steady upward growth of Arbor's underlying asset, a $36.3 billion Fannie Mae and Freddie Mac mortgage servicing portfolio. This servicing portfolio generates a recurring stream of fee income. It is risk-insulated, performing independently of the broader macroeconomic noise or the panic selling hitting the stock. A low stock price alone is not a signal of value. Many things are cheap for good reason. To evaluate Arbor, we have to pull apart the structural mechanics of its cash flow. Because Arbor is a real estate investment trust, or REIT, it must distribute the majority of its income to shareholders as dividends. The durability of its cash flow dictates the survival of that payout. The central question for investors is why a company backed by a massive, insulated cash annuity is being priced like a failing enterprise. To find the answer, we will map Arbor's closed-loop revenue models step by step. We need to locate exactly where the actual vulnerabilities are and where the evidence suggests the market is overreaching. Two colliding forces are dictating the company's future. They are taking real, cyclical hits on their legacy apartment building loans, while simultaneously executing a structural pivot towards single-family rentals. Understanding the true value requires looking past the ticker tape and deconstructing the internal financial engine that drives the business. Arbor operates a self-feeding three-phase revenue machine designed to extract fees at every stop of a property's lifecycle. Phase 1 is the bridge loan, short-term floating-rate financing for actively renovating properties. Because they carry higher risk, they throw off high origination fees. Once stabilized, Arbor executes the recapture, refinancing that borrower into a permanent agency loan. When Arbor originates this new permanent loan and sells it to the agencies, they earn a gain-on-sale margin, functioning as a substantial commission. Those permanent loans are sold to government-sponsored enterprises. Arbor holds a highly restricted designation to originate directly for Fannie Mae. They hold an equally strict license to originate and service loans for Freddie Mac. Then we reach Phase 3, the annuity. Arbor retains the mortgage servicing rights, collecting predictable fees for the next decade. Because these loans are government-backed, Arbor isn't on the hook for defaults. Historically, 50% of bridge loans recapture into this risk-insulated pipeline. In a frozen market, Arbor doesn't need to compete for external clients. They generate their own deal flow by refinancing their internal book of business. In a normal environment, this closed-loop conveyor belt creates a durable profit engine that feeds itself. But 2026 is not a normal environment. Commercial real estate is actively colliding with a massive maturity wall, a wave of short-term bridge loans, written at the 2021 peak of the market that are now coming due. This illustrates the current bottleneck. Elevated treasury yields keep permanent mortgage rates high, while an oversupply of apartments flatlines rent growth. Combined, many properties no longer generate the strict debt service coverage required to qualify for Fannie or Freddie refinancing. The distress is concentrated in the Sun Belt. Nearly 40% of Arbor's portfolio sits in Texas and Florida, where rent growth has stalled near zero. These markets absorbed heavy capital during a boom, resulting in a structural oversupply that pressures rents. Heavy construction continues in these areas, ensuring this excess supply will take several quarters to burn off. A secondary headwind is compressing property values. Landlords of small multifamily properties are facing a squeeze, with operating expense ratios hitting a record 47.3%. Operating costs, driven by insurance premiums that doubled over 5 years, are compressing net operating income for these legacy assets. Since these borrowers cannot yet qualify for Phase 2 refinancing, Arbor utilizes extend and modify tactics to prevent defaults. This requires a cash-in modification. Borrowers must inject fresh equity to pay down interest, buying 12 to 24 months to reach stabilization. In the first quarter of 2026 alone, Arbor processed $480 million in these bridge loan modifications. While avoiding immediate catastrophe, it forces Arbor to carry high-risk bridge loans on its balance sheet for longer, exposing its capital to near-term credit risks. The recapture pipeline is not broken, but it is delayed, keeping capital exposed to cyclical distress while properties work through the bottleneck. To combat this apartment sector distress, Arbor is rotating its capital away from legacy multifamily buildings and into single-family rentals, or SFR. This is the new target asset: individual houses built or purchased specifically to rent out to families. Arbor has already committed $3.27 billion of its bridge loan balance to the single-family rental market. This pivot is anchored in a structural reality. The average American is now mathematically locked out of buying a home. The median household now devotes 42% of its income just to purchase a house. The door to homeownership is shut tight. We measure the strength of this market using cap rates, the annual rental income a property generates divided by its purchase price. This matrix compares the unit economics. Legacy multifamily cap rates hover around 5.5 to 5.8%. Single-family rental cap rates have climbed to 7.4%. Operators earn significantly more per dollar invested, and demand is stable, with SFR occupancy holding at 93.9%. Contrasting the stalling Sunbelt apartments, all 50 of the largest U.S. single-family rental markets posted positive rent growth in early 2026. At 7.4%, the math for single-family rentals pencils out in a high-rate environment, forming a reliable engine for Arbor's future pipeline. Arbor's current valuation efficiently accounts for the quantifiable pain of its legacy Sunbelt bridge loans. However, this focus on near-term pain leaves the underlying structural assets that survive credit cycles unvalued. Those assets include the $36.3 billion GSE servicing portfolio, 7.4% single-family rental yields, and an internal pipeline feeding on the refinancing necessity driving the market. The pain of the maturity wall is a highly visible, predictable calendar event. Arbor's geographic portfolio mix is already rotating to move past it. The investment thesis relies on an asymmetric bet that over a 3 to 5 year horizon, the market will eventually distinguish between temporary cyclical distress and permanent structural value.